Hi, I'm going to be demonstrating problem CP11-1, which can be found in your text on page 523 or in the Connect Assignments folder, the Chapter 11 Practice Problems, and the Chapter 11 folder in Blackboard. If you've not yet read the first two learning objectives for Chapter 11 or watched the interactive presentations in Connect for the first two learning objectives, please stop this demonstration, do so, and come back later to view it. It will make this much more easier. This problem deals with both the issuance of common stock and the repurchase of a corporation's stock, which is called treasury stock. Before we go through the problem, let me review a few things. If a company has one type of stock, it's called common stock. Common stock can either have a par value or be no par common stock. Par value is an arbitrary amount authorized in the corporation's charter, and it indicates the amount that will be credited to the common stock account. If you issued stock, which means sold stock, above par value, then any amount over par goes into the additional paid-in capital account. So only the par value of a stock goes into the stock account. If you have no par stock, the entire amount you receive from issuing or selling the stock goes into the common stock account. So the main difference is, with par value stock, credit the common stock account for only the par value and put any extra in the additional paid-in capital account. For no par stock, put the entire amount you receive into the common stock account. What if instead of common stock, you're selling preferred stock? Well, recall that preferred stock is stock that has different voting rights, and it receives its dividends first, which is usually the same set amount. Preferred stockholders also get their share of assets first if the company is going out of business. When you record the issuance of preferred stock, it is exactly the same as the journal entries for common stock, except that you change the word common to preferred. A company may decide to buy back its own stock for a variety of reasons: to distribute excess cash to stockholders, to obtain shares for an employee stock option program, or to prevent a hostile takeover. When a company does this, we debit the purchase price of the stock to the Treasury stock account. Treasury stock is a contra stockholders' equity account. It is not an asset. It is a deduction from total stockholders' equity on the balance sheet because we have bought back our own stock and returned the stockholders' investment to them. When the stock is sold to the public again, we debit cash for the amount we sold it for, but we credit treasury stock for the amount we originally paid. Any difference would go into the additional paid-in capital account as either a debit or a credit. Okay, now let's take a look at problem CP11-1. Again, it's on page 523 in your text or in the Chapter 11 Practice Problems in Connect. Worldwide Company obtained a charter from the state in January that authorized 200,000 shares of common stock, $10 par value. During the first year, the company earned $38,200, and the following selected transactions occurred in the order given. And we're going to have to do journal entries for these three transactions. So I'm going to scroll down to the section where we can record our journal entries. In our first transaction, it tells us to record the issuance of 60,000 shares of common stock with a par value of 10 for a price of $12 a share. Okay, remember, in every transaction, we're giving something and receiving something. In this case, we're receiving cash. Cash is an asset. We debit cash to increase it because assets are on the left side of the accounting equation, so we left side our debit to increase. We're going to multiply 60,000 times $12 a share and receive $720,000 in cash. But recall that if stock has a par value, we are going to credit the stockholders' equity account, common stock, for just the par value, which is 60,000 times 10, or $600,000. The difference, the extra amount, The extra $2 a share times 60,000 shares, or 120,000, goes into the additional paid-in capital common stock. Both common stock and additional paid-in capital common stock are stockholders' equity accounts that we're going to see on the balance sheet. Next journal entry. They want us to record the purchase of 2,000 shares of previously issued common stock for a price of $15 a share. In this case, we are buying back our own stock and we're paying $15 a share to do so. When we buy back our own stock, we debit Treasury stock. This is a contra stockholders' equity account. Notice we're debiting it. Normally, we credit stockholders' equity accounts because they're on the right side or credit side of the accounting equation. Treasury stock is a contra stockholders' equity account, so we'll debit it for the purchase price, $15 times 2,000 shares, or 30,000, and we'll credit to reduce cash because that's what we paid. In our third transaction, we are reissuing 1,000 shares of the Treasury stock we previously had purchased for $15 a share, and we're selling them for $18 a share. Purchased for $15, resold for $18. So let's debit cash for the amount we're receiving. $18 a share times 1,000 shares, or $18,000. We're going to credit Treasury stock for the amount that we originally paid, $15 a share times 1,000 shares. To reduce Treasury stock by $15,000. And the difference, the extra $3,000, goes into an additional paid-in capital account. We're going to choose the one that says Treasury stock. We cannot record a gain on the sale of our own stock. We record any additional amounts received in the additional paid-in capital account, which is a stockholder's equity account. Let's record that entry. And now I'll click on Done to show all 3 journal entries. What I would recommend with problems that have multiple journal entries is that when you have to produce a statement of retained earnings or a statement or a balance sheet, that you draw T accounts on a sheet of paper and keep track of the account balances to make doing the stockholders' equity section of the balance sheet a little easier. So I'm going to scroll down, and we are told to prepare the stockholders' equity section of the balance sheet at December 31st. Amounts to be deducted should be indicated by a minus sign. And it says because this is the first year of operations, retained earnings has a 0 balance at the beginning of the year. Okay, so we're going to start by doing the contributed capital section. Contributed capital is for amounts contributed by stockholders. If we had preferred stock, that would be listed first. We don't, so we will list just our common stock. And if I had T accounts that I could show you, I would show you what the balance is. We're going to have to scroll up and see the only entry that affected common stock was the first one, and there was a $600,000 credit to common stock, so we will list $600,000 here. We next put our additional paid-in capital related to common stock, and again I scroll up. The additional paid-in capital related to common stock is $120,000. We have no preferred stock, but we do also have additional paid-in capital related to the Treasury stock. Now, originally, let's see, here we go. We have $3,000 in this account, and there are no other transactions involving the additional paid-in capital Treasury stock account. So we'll simply put $3,000 here. Our next section below contributed capital will be retained earnings. And they told us, I believe back in our original problem information, that during its first year, the company earned $38,200 in net income. If there were no previous balance in retained earnings, then the entire amount would have been put into the retained earnings account. It doesn't say anything about issuing dividends, so we'll assume that retained earnings is $38,200. And our final step here is to subtract out the treasury stock at whatever we paid for it. Let's take a look at that journal again. We had a debit balance in treasury stock with transaction B, and then we credited treasury stock for $15,000. So a debit of 30, a credit of 15 gives us a net debit of $15,000. We're going to show this with a minus to indicate that we're subtracting. And our ending balance in stockholders' equity is $746,200. Now, why do we subtract treasury stock? Well, recall the amount of stock that you originally issued was up here in common stock and additional paid-in capital. When we bought back our own stock, we never reduced the common stock account. We recorded the repurchase stock in the treasury stock account. So instead of reducing common stock and additional paid-in capital, we are reducing stockholders' equity by recording that amount in a contra stockholders' equity account called treasury stock. This was the amount that we have returned to stockholders as their investment. One last bit of information about treasury stock is that treasury stock is a type of stock that you are temporarily holding. You're planning to reissue it at some point in time. If you wanted to permanently return the stockholders' investment to the stockholders, you would debit common stock and additional paid-in capital. We're not retiring stock. The stock will be reissued at some time in the future. Okay, problem CP11-1 is done. Why don't you go ahead and try a practice problem or your homework problems as well? Have a good day.